Have you ever wondered if a single law could change the way banks operate, reshape an entire nation, and alter the lives of millions of ordinary people? In 1933, America was in chaos, drowning in the deepest economic crisis it had ever faced. The Great Depression was not just a temporary downturn, it was a complete collapse of financial confidence. Millions of Americans had lost their life savings. Banks, once trusted pillars of local communities, were closing their doors every day. The streets were filled with people desperately trying to withdraw whatever little money they had left. Families waited in long lines, sometimes for hours, hoping to get just a few dollars to buy food. Businesses had gone bankrupt. Unemployment was staggering, with nearly 1 in 4 Americans out of work. The stock market crash of 1929 had set off a chain reaction that the country was still struggling to recover from. The very trust that people had in their financial institutions was gone. Banks had failed, fortunes were wiped out, and the economy had come to a standstill. In towns and cities across the country, the fear of losing what little money remained was palpable. It was clear to everyone from ordinary citizens to policymakers that the existing banking system was fragile, unregulated in many ways, and dangerously intertwined with speculation. It was in this environment of fear and uncertainty that Franklin D. Roosevelt and Congress introduced one of the most significant financial reforms in U.S. history, the Glass-Steagall Act. This was not just a law on paper. It was a radical restructuring of the American banking system, designed to protect everyday Americans and restore trust in financial institutions. At its core, Glass-Steagall drew a clear line between two types of banking: commercial banking and investment banking. Commercial banks were the institutions people relied on to store their savings, give loans, and support local communities. Investment banks were the ones that bought and sold securities, invested in stocks, and took higher-risk bets on financial markets. Before Glass-Steagall, there was little distinction between the two. The same bank that held your savings could also be using that money to speculate in the stock market. When the market crashed, the losses affected not only wealthy investors, but also everyday depositors. Your money, your savings, the security of your family's future could vanish overnight. Glass-Steagall said, "Enough." It created a firewall between public deposits and speculative investments. Commercial banks could no longer gamble with depositors' money in high-risk markets. Investment banks could still take risks, but only with their own capital, not with money from ordinary Americans. This separation of banking activities was revolutionary at the time. It was a law designed to protect the public, stabilize the economy, and prevent another financial disaster on the scale of the Great Depression. At the same time, the Glass-Steagall Act established the Federal Deposit Insurance Corporation, or FDIC. The FDIC insured Americans' deposits, meaning that even if a bank failed, depositors would not lose all their money. This guarantee was a lifeline, restoring confidence in the banking system almost immediately. People once again felt safe depositing their money, knowing it was protected by the government. Banks could focus on their core responsibilities, lending money to small businesses, supporting local economies, and serving their communities without being distracted by higher-risk speculation. The effects of the Glass-Steagall Act were profound and far-reaching. Within a few years, Americans began to regain trust in their financial institutions. Commercial banks became more stable, focusing on lending and community banking. Investment banks continued to take risks, but they did so using their own funds, not the money of unsuspecting depositors. The FDIC's guarantee provided peace of mind to millions of Americans who had previously lost everything. Slowly but surely, the economy began to recover. The banking system became more stable, and public confidence returned. Over the next several decades, the separation of commercial and investment banking helped prevent widespread financial collapses. Bank failures became far less common. The law became a foundation for trust in the American financial system. For ordinary Americans, Glass-Steagall was not just a technical law, it was a reassurance that their savings were safe. It created a sense of security and stability in a world that had been shaken to its core. But like any law, Glass-Steagall was not perfect, and over time its protections were slowly eroded. Banks and financial institutions found loopholes in the legislation. They used holding companies, separate subsidiaries, and creative financial structures to gradually blur the line between commercial and investment banking. By the 1980s and 1990s, Wall Street and powerful banking lobbies argued that the law was outdated. They claimed that Glass-Steagall was holding back economic growth and limiting financial innovation. These debates led to changes in policy, and eventually, parts of Glass-Steagall were repealed. In 1999, the Gramm-Leach-Bliley Act effectively removed the firewall between commercial and investment banking. Banks that were once strictly separated were now allowed to merge and offer both commercial and investment services. At first, this seemed like progress. Banks grew larger, profits soared, Wall Street celebrated. But the repeal of Glass-Steagall had unintended consequences. In the mid-2000s, the stage was being set for a financial crisis that would shake the world. Banks now allowed to combine commercial deposits with higher-risk investment strategies, or taking massive risks with other people's money. When the housing bubble burst in 2008, the consequences were catastrophic. Millions of Americans lost their homes. Stock markets plunged. Financial institutions teetered on the brink of collapse. The lessons of the Great Depression were suddenly relevant again. Glass-Steagall had originally existed to prevent this exact scenario. Its absence contributed to a crisis that affected not just Wall Street but Main Street, every corner of America, and even the global economy. Glass-Steagall teaches us an essential lesson. Laws aren't just words on paper. They are the foundation of trust. They protect ordinary people. They stabilize entire economies. When those protections are weakened or removed, the consequences are real, immediate, and devastating. Imagine being an average American in 1933. You've worked your entire life to save a modest sum for your family. You deposit it in a bank, trusting that it's safe. Then the stock market crashes, and suddenly, your money is gone. Glass-Steagall was designed to prevent that scenario. It was created to protect every American, to ensure that the financial system could serve the people rather than endanger them. Even decades later, the story of Glass-Steagall remains relevant. Whenever we hear debates about banking regulations, financial reforms, or economic stability, the principles behind Glass-Steagall are at the heart of those discussions. They remind us that regulations are not just bureaucratic red tape, they are shields. Shields that protect ordinary people, their savings, and the broader economy. The law also reminds us how fragile economic stability can be when protections are removed. History shows that financial crises are not random. They often follow the removal of safeguards that were carefully put in place for the public's protection. The story of Glass-Steagall is also a story of human resilience. It's a story of ordinary Americans who lived through the Great Depression, lost everything, and slowly regained trust in a system designed to protect them. It's a story of lawmakers, bankers, and citizens learning from past mistakes and taking action to prevent future disasters. It's a story that resonates even today, when new financial products, digital banking, and global markets create both opportunities and risks. Glass-Steagall reminds us that stability, trust, and regulation are intertwined. They cannot be taken lightly, and the consequences of neglecting them can ripple across decades. Even now, policymakers, economists, and everyday citizens study the lessons of Glass-Steagall when considering how to regulate modern finance. The law's legacy extends far beyond the 1930s. It shaped the way Americans think about banks, risk, and government oversight. It influenced global financial systems, banking policies, and the very idea that money entrusted to banks must be protected. Without laws like Glass-Steagall, the economy can descend into chaos. Confidence can evaporate, and millions of lives can be disrupted. The law also shows that financial reform is not just about economics, it's about human security, trust, and dignity. By protecting everyday people, Glass-Steagall created the conditions for economic growth, stability, and opportunity for generations. Even as it was weakened and partially repealed, its history serves as a warning and a lesson for future policymakers. Glass-Steagall illustrates the delicate balance between innovation, risk, and protection. It reminds us that economic growth should never come at the expense of the public's security. Every financial crisis, from the Great Depression to the 2008 meltdown, traces its roots back to decisions made about regulation, risk, and oversight. The story of Glass-Steagall is a story about prevention. It is about foresight, about creating systems that prioritize the public interest. It is about understanding that banks serve society, not just themselves. And it is about the consequences of forgetting that simple truth. Today, when we navigate a world of complex financial instruments, digital currencies, and global banking networks, the lessons of Glass-Steagall remain as relevant as ever. They remind us that trust cannot be taken for granted. They remind us that regulation is not a burden, it is a necessity. They remind us that the safety of millions depends on thoughtful laws, strong oversight, and a commitment to protecting the public. Glass-Steagall also shows us that change is possible when the system fails, when the people suffer, when confidence disappears. Decisive action can rebuild trust. It shows that one law, carefully crafted and enforced, can prevent disaster and preserve the well-being of an entire nation. And yet it also warns us that vigilance is required. The protections it offered can be undone if we forget the lessons of history. That is why the story of Glass-Steagall is more than a historical episode. It is a living lesson for all of us policymakers, bankers, and citizens alike. It is a reminder that the economy is not just numbers on a chart, but lives, families, and communities. Glass-Steagall demonstrates the profound impact that thoughtful legislation can have when it is designed to serve the people. It also demonstrates the consequences when those safeguards are weakened. As we look to the future, the principles behind Glass-Steagall remain vital. Trust, transparency, and the careful separation of risk are essential to a stable economy. Without them, history shows that the consequences can be catastrophic. By studying the Glass-Steagall Act, we learn not only about banking, but about the importance of foresight, responsibility, and protection in all aspects of economic life. It teaches us that financial stability is not an abstract concept, it is something that directly affects the everyday lives of millions. And it reminds us that one law, if carefully designed, can protect countless people from the chaos of unchecked speculation. Glass-Steagall is more than a lit, is a legacy. A legacy of protection, trust, and the enduring lesson that economic policy is ultimately about people. It is a reminder that in finance, as in life, foresight and prudence are worth more than unchecked ambition and short-term gain. And so even decades after its enactment, the story of Glass-Steagall continues to shape American finance. Public trust in the very way we think about banking. It remains a blueprint for stability, a warning against recklessness, a testament to the power of law to safeguard an entire nation. Thanks for watching. Want more deep dives into history, finance, and the moments that change the world? Subscribe and turn on notifications so you don't miss the next episode.